So I think because we lived in this abnormal market where I think people forgot what a normal market is. And I think instead of normal, you like to use a healthy market.
Yes.
So it'd be nice to kind of just talk about, since you're the data guy and you study housing, not just from the home sales, but when you think of a healthy market nationally, what comes to mind? I think of how many days are on the market and inventory and sales and all this stuff. What comes to mind, and what is a healthy market if we ever get back there?
So,
all right, guys, so I'm live with Logan Mohtashami, live at the HousingWire event. Logan, we are live in person.
I know, after all these years, finally.
I'm excited. All right, so I know we have limited time, so let's jump into it. So I heard today you talked a lot about data and all that. I think really what I want to do is dumb this down for the consumer. So somebody that's looking to buy, maybe a real estate agent, somebody that's selling, kind of what in the world's going on. So can you just kind of come back out of the pandemic and kind of just what have you learned from the pandemic, from lockdown and now? What is the real problem going on right now in housing when you look back 3 years?
It's always what I feared the most. Inventory levels broke all-time lows, but it broke at the worst time. Years 2020 to 2024 was always my period I've been waiting for 10 years, just because so many millennials, move-up buyers, move-down buyers, cash buyers, investors, you put them all together, the potential of inventory breaking at the worst time was there, and home prices escalated out of control. But even with that, even with mortgage rates up to near 8%, even with the smallest crash ever, the housing market still stayed as so much of the credit channels and credit data that we have in the U.S. is so much better than everywhere else. That homeowners are shielded. And for the first time in a very long time, we not only had a shield against inflation as a homeowner, but you had a shield against the Federal Reserve's massive short-term rate hike policy. So it just proved that even in the craziest housing market time, that had homes and a very good fixed payment, shielded you against all the troubles that the economies were dealing with.
So I'm going to read three different things that you and I hear out there on a daily basis. And I want you to kind of tell me which one you're in the camp of. Okay, rates are going to go down, and then inventory is going to pick up, and prices will drop 10%. Rates are going to go down, inventory picks up, but there's going to be too many buyers, so prices will stay level or go higher. Or rates are going to go down, inventory will increase a ton because we're going to have a nasty recession, millions of people lose their jobs, and prices are going to drop 20 to 30%.
None of the above.
None! Oh.
No, so the history of lower rates after 2010, inventory stays flat or goes lower. In 2021, a lot of people thought nobody listed their homes in COVID, mortgage rates are low, everyone's going to list their house in 2021. Forbearance, home prices down 20% easily. Not the case. Majority of sellers are buyers, so naturally credit channels run the show. So if you list your house, you can buy one. The issue with housing now is that for the longest time, first-time home buyers were picking up. Millennials are the biggest home buyers in America. Well, they don't offer you a house most of the time to buy a house. So inventory stays low and lower if rates fall. Now, regarding the job loss recession, assuming that occurs, during COVID-19, I talk about, housing will pick up just 6 or 7 weeks. No, there's 20 to 30 million people unemployed.
Pretty much nailed
that.
There's
5 million people in forbearance. How can housing rebound? Well, guess what? It rebounded 6 weeks.
6 weeks, yeah.
6 weeks. That's all it took, right? So the reason this happened was because, guess what? There's 133 million people working with low rates. So rates fall, even if you lost 2 million jobs, you still have 155 million. My army's bigger than yours, right? So you got 155 million people working, so rates disproportionately help housing when it goes lower, disproportionately impacts housing negative when it goes higher. Last year was a great example. We created 4 million jobs, but the housing market had the biggest home sale crash in history just because rates went up so much. So rates work both ways. Traditionally, if they go lower, it's a benefit. What happened during the housing bubble years is that we had massive inventory spike all before the job loss recession, right? 2005, 6, 7, and 8, inventory spikes, credit was getting broken down. Not the case anymore. So homeowners are sitting really good, waiting it out. Rates fall, the growth rate of inflation falls next year. The Fed starts cutting rates because real rates are so high. That's a positive for housing. It wasn't the case for this year. Labor market is still too tight. Next year, the backdrop is back.
So do you see rates are going to come down? I mean, I think there's a tremendous amount of buyers sitting on the sideline. You agree with that?
You've got probably 2.8 to 3.7 million buyers, on top of the millions of people that buy homes every single year. And even this year, we had near 5 million total home sales. So that 1% lower to an additional 4 to 6 million buyers anyway. So there are buyers there, but the 10-year yield is high right now. Lower rates with duration get buyers to 50 million.
Do you kind of foresee, if you're going to take a guess, that housing prices are going to be more going up than down? If we get the lower rates, you think,
The best thing against prices growing, higher rates, longer period of time to sell a home, price cuts have to happen. That's, we saw that the second half of 2022. Last year was unique because home sales had the biggest crash ever. Not the case anymore. Even now, and I think this is the confusing part for a lot of people. They see home prices higher and mortgage rates higher, sales slowly falling down lower. It's different because we're working from a lower base. Last year, January sales was 6.5, crashed down to 4 million. Now we're just hovering around 4 million. So we have the lowest bar ever in history, upwards, not downwards. And it's really rare in America after 1996 for existing home sales to trend 4 million. Authentically, it's only happened one time, a few months in 2008. After that, home sales should just grow. So it's all about the 10-year yield with me. Lower rates helps demand. We have a very low bar. We saw a glimpse of that last year, November, December, January. 10-year yield fell, purchase application data had 3 months of positive data, gave us one of the biggest month-to-month sales prints ever. So the demographics are there, the affordability issue is a problem, but the one way to solve that in the short term is the 10-year yield does fall, the rates fall, and create more buyer demand, more sellers that will be buyers as well.
So does the other thing that I think people, when I'm talking to you, I'm thinking about what consumers are hearing on this, daily basis. They're hearing the country's $33 trillion in debt. We have super high rates. There's no inventory. Credit card debt is all-time high. Savings rate was at 35. Now it's down. Student loan payments are back. Car payments are very high. So it's like doom and gloom, right? And that's what they think. So people are like, how is this economy not going to blow up in the whole housing market? And I know we just talked about that, but they're hearing this crap every day and they don't know how to, get through it.
As the presentation showed, what they show you is nominal credit card debt is rising, but versus a percentage of income, it's actually much lower than what it was in the 80s and 90s. And I think that's the trick. The doomsday people actually show $1 trillion of credit card debt. They don't tell you $167 trillion of financial assets. And then household debt payments as a percentage of disposable incomes are still near all-time lows for mortgage payments and for household debt payments. So traditionally what occurs is that the people on the lower income side, when energy prices rise, rates rise, they get hit. But as a country, majority of people are still spending. And of course, if there's a credit problem issue out there, if the Fed finally breaks something, that changes the landscape. But for now, it's not shocking that, the economy's still moving on because household balance sheets have never looked better. And hopefully all my work over the years, I've tried to emphasize that by using the proper charts because for 10 years, people said, credit card debt's growing. It grows every single year in an expansion, right? There's nothing abnormal. Credit card utilization rates are still actually pretty normal right now. So we don't see the mega growth in credit card data that you would see with utilization rates going up. So far, everything's held in check. It's just for the housing market, you need that 10-year yield to drop. If the one sector of the economy that has home sales still depressed.
So speaking of 10-year treasuries, what we look at daily, where's the Fed wrong here? Because, the Fed it's amazing that people that probably never understood the Fed, they understand what the Fed's job was, but they understand the vocabulary that comes out of his mouth, the emotions, what they say, what they do, how it literally is controlling everything. And I think people realize. So where do you think the Fed went wrong?
Here's the one thing. The Federal Reserve had a game plan going. The last few weeks, they were talking about, the growth rate of inflation falls, real rates, which means where the 10-year yield and Fed funds rate is and inflation is already restrictive, so we can maybe cut rates next year even without a job loss. So the problem that happened recently is that their Fed meetings, they were way too hawkish, and bond traders just made them pay for that, right? The bond traders very short the market, a lot of supply coming on. They went ahead, and now the Fed is trying to backtrack. Every single day, we've got 6 different Fed presidents coming out last week and saying, no, listen, we don't want this. And that's the thing is, Sarah and I talk about this in the podcast. Real yields are already restricted for them. So if the 10-year yield goes up above 4.25, we're going to have to talk this down. And guess what? Not only did 6 presidents talk it down, Janet Yellen even had to come down and try to talk the market down. So I think it overdue the staying hawkish too long side, and there's no need to do it. If you want to land the plane. If you want to crash the plane, then you're completely happy with what bond yields are doing. But if you're authentic about a soft landing at this point, just let the markets do its thing. You don't need to push it anymore after all the rate hikes and where the 10-year yield was. That hawkish statement really made him pay very quickly.
So as Logan says, it's time to land the damn plane.
Just land the damn plane.
Put it in put it away and just let it be. Just let it be.
Go retire, go fishing somewhere, and enjoy your life.
So I think because we lived in this abnormal market where I think people forgot what a normal market is. And I think instead of normal, you like to use a healthy market.
Yes.
So it'd be nice to kind of just talk about, since you're the data guy and you study housing, not just from the home sales, but when you think of a healthy market nationally, what comes to mind? I think of how many days are on the market and inventory and sales and all this stuff. What comes to mind, and what is a healthy market of if we ever get back there?
So I have this metric for getting the housing market out of the savagely unhealthy housing market. Days on market, 30 to 45 days normal, right? Whenever we're in a teenager on the days on market, nothing good's happening.
Okay, so nothing's good happening.
No, you either have a massive credit boom, which we didn't have, or you just have too many people chasing too few homes. My theory has always been we have too many people chasing too few homes. So if the days on market using the NAR data nationally is over 30 days, that's good. If total active listings just gets back to 2019 levels, right, which is still below the 4-decade average, that takes the savagely unhealthy market away. But if total inventory is still near all-time lows, and the days on market, even with mortgage rates near 8%, are still 20 days, that's not a good thing. And let me give some perspective. We have the Altos research at HousingWire. In March of 2022, only had 240,000 single-family homes available for sale as a country on that 1 week. That was the lowest levels ever recorded in history. For a country of 335 million, 157 million working, that's way too much. So if people are shocked that pricing is still staying firm, that's just because we're still too many people chasing too few homes. And home sales have stabilized from the crash that they had in 2022.
We've been working on this for the past few months. We always want to bring as much value as we possibly can, and our partner, Prime Corporate Services, is all about bringing you a service you can't get anywhere else at a price you can't get anywhere else. Whether you're new to owning a business or owning a property, or you're an experienced property owner or investor, Prime Corporate Services is not only going to help you, but they're going to make the process so much easier. So if you book a call, the first thing they're going to do for you is help you understand what your business structure should look like, your corporate structure, tax planning, estate planning, all of that. Maybe you're saying, I'm brand new to starting a business and all this sounds foreign and complicated. Remember, this company helps new people just getting started every day. They're going to help you form the entity that's best for you and walk you through the process. Before I found this company, we paid thousands of dollars to other attorneys, CPAs, and consultants to try to understand exactly how we need to be structured to be as protected as possible. We've also gone the other route and used online platforms to form entities which unnecessarily put us at risk. You guys, you don't have to do that with this company. They'll do all of these things for you at a reasonable price, so you never have to think about saving money at the expense of exposing yourself to liability. We've searched high and low, and you will not find this much value anywhere else. All you have to do is schedule a free call today. Just go to primecorporateservices.info/GITCG. Once again, that's primecorporateservices.info/GITCG. We'll also leave the info for you in the show notes.
So I think also too is I think everybody's scarred from 2008, and so we hear the housing crash boys, the YouTube celebrities. Literally had a friend that said, if you want to get 1 million subs on YouTube, just say the housing market's going to crash and you'll get there, right?
Oh yeah. The bubble boys, the forbearance crash boys, everything. The reason why I love to challenge all of them live, because it'll take me less than 10 minutes to break their economic theories. A lot of these people don't actually forecast or don't have any models, but they're unbelievable professional grifters. I give them that.
So since 2008, we've got, and correct me if I'm wrong, 30 million new people in the country. We really did not build that much from 2008 to about 2012, I think. Inventory is tighter than ever. We've made better loans. 95% of mortgages are on 30-year fixed rates. We're looking good. I mean, like when
We
you look
are-
at stuff, like
the U.S. housing market's credit strength is not only the best in the world, it's the best in history because we have the 30-year fixed mortgage. Other countries don't have that. It's a problem like in countries in Canada and London where recast rates are high. Here, you have to think of housing as this: fixed debt cost, rising wages, people leaving their homes longer. Their total housing costs versus their incomes aren't that high. So they're waiting, right? And that probably explains why, even with the biggest home sale crash ever, inventory didn't really grow that much in the existing home sales market because people are employed and working. There's no recast rate risk. This isn't the loans of 2002 to 2005 that we saw the big spike in inventory. And I think people forget, total inventory was growing from the year 2000 to 2005 with booming sales. Not the case anymore, right? Everything changed in housing after 2010 with the qualified mortgage. And we're all better for it because housing credit, if it's very vanilla, it's a good thing. When it gets exotic, it gets problematic. So borrowing is a good thing for housing.
so 42. I was the guy that yelled out 42% today. 42% of houses are free and clear, and out of that, 95, 90, let's say 92% of them 5% or less. So what worries me is that when I talk to clients and I talk to customers and I talk to other people in the industry like you do, and the feedback I'm getting is, hey, Kenny, my client that's got the 2.5, the 3.2, the 1.99, and 15 all this, they're never selling. And even if I have buyers that are trading up out of their houses, they're locked into 2.5 and then they're just keeping the house, renting it cash flowing and going to another house. What kind of scares me is the affordability thing, but also for the consumer coming in to buy, because of COVID, because the Fed might not realize, the Fed guy came out and said, we didn't realize people wouldn't sell their homes. They locked in. So what, are we going to have just a problem for a long time where we're just going to have an inventory problem and then we're going to be kind of playing this like inventory game for a while?
You know, I draw these inventory charts and I draw these black lines for very long periods of time. And inventory slowly has moved lower. Even if there wasn't COVID or even 2.75% mortgage rates, we still have the same backdrop. Every week, thousands of people list their homes to sell. They list their homes, they sell their 3-4 mortgage rate, they buy another house. Housing tenure, just living their homes longer and longer. And that's part of the problem. We don't ever talk about it enough. But even if they had 4 or 5% mortgage rates, they only move when they need to. And from 1985 to 2007, housing tenure was 5 to 7 years. From 2008 to 2023, depending on who you listen to, it's 11 to 13 years. Parts of the U.S. and California, for us, it's 15 to 18 years. I've lived in my home for 20 years, right? So we don't have a lot of turnover anyway. And the turnover is usually from people that need bigger space, work from home, something to that nature. But everyone else is doing fine. So it's a difficult problem to have, but I always say, talk about a first world problem. You know, homeowners are doing good. They're living in their lives. Their cash flows are good. But that does impact inventory. That's why construction is very positive. You have to keep the construction building keep on going because they have to offset the reality that people are just staying in their homes longer and longer.
What is your biggest concern about the market today? And then when you look out in 24 months from now?
Same thing as always. We still are stuck with the too many people chasing two homes. And when rates do go lower, we don't get any traction, right? And the problem of not getting traction is that the active inventory is low. Now, people say, how can you have millions of home sales with such low inventory? Remember, sellers are buyers. You list your homes. If you sell the home very quick, it doesn't get into the active inventory data. So you could have rising sales and have active inventory so low, but you need that seller that becomes a buyer. And just the concern is that even when rates go low enough, we get into the bidding wars again. Savagely unhealthy housing market continues because the days on market are too low. And that's always been it's always been a focus of mine in years 2020 to 2024 because we have the demographics for this. And hopefully we don't have to live through that much longer.
So Logan, your best friend calls you right now. Ring, ring, you pick up and you go, hey, what's up? And he goes, Logan, I need your honest answer. Should I buy a house right now and lock in on these rates, or should I wait until rates drop to 5%?
You know, I always have the same answer for this. and then, you know, for 10 years, if somebody asks me if they should buy a house, I tell them, you're not ready to buy a house.
That is your answer.
Because honestly, as an adult, you know what you can afford. You go to your mortgage person, you get pre-qualified. Basically, you have your answer for you. And if you have to ask someone, should I buy a house? You are not ready. Millions of people buy homes every single year.
Millions.
We're going to have 5 million total home sales again. They're ready. So if somebody asks me, they're telling me right away, they're not ready. Because this decision should not be that difficult. It is a fixed total cost payment. That's it. There's no more exotic loan debt structures anymore, right? So I always say, if you're asking me if you should buy a home, you're not ready to buy a home. When you don't have to ask anyone, you know, like everyone else, okay, I'm ready to go. We're going to have millions of people buy homes this year. Then you're in. But as long as you're asking someone else, no, you're not ready.
So when you wake up every morning, and I know you're getting right into the data, what are the three things that you're looking at in the market to kind of start your day out?
The 10-year yield, the 10-year yield, and the 10-year yield. You know? So I'm just a bond market guy, and when I went on CNBC early in the year, I said, listen, the housing market is just going to revolve around the 10-year yield, right? Because I always say there's this lovely slow dance relationship between the 10-year yield and 30-year mortgage rates. I know a lot of people, focus on the mortgage-backed securities, but that slow dance has been working here for a long time. So you need the 10-year yield to fall for mortgage rates to fall. And that, to me, in regards of housing, even in the general economy, that's the biggest deal right now. Of course, with the general economy, jobless claims to me at this stage of the cycle is the most important data line. But I wake up, I take a look at that 10-year yield at midnight before I go to bed, and then wake up right in the morning and see where it is, because that, to me, drives the housing demand. And we need that thing to come lower and stay lower with duration for that to really impact housing on the positive side.
And what do you think I know there's spread, obviously the spread over the 10 years is out of whack right now, but what do you think in a healthy market, a healthy 10 year is going to look like, whether it's 6 months, 8 months, or 12 months, or whatever it is from now?
If you got the 10-year yield between 2.72 and 3.37, get that, and the spreads get better, you have sub 5% mortgage rates.
You have a rocket market.
Yeah.
So there's going to be a lot of stuff going on.
You got a lot of sellers who are going to be buyers in that marketplace. Getting the 10-year yield and the spreads back there is going to be a little bit more problematic than people think. But we got a glimpse of what it looked like for 3 months last year, November, December, and January. And we had one of the biggest month-to-month home sale prints ever, even with houses where they were. So hopefully, in the future, things get better on the spreads part. The Fed calls surprise uncle, and they start cutting rates and help the economy, and housing disproportionately gets impacted in a positive way with lower rates.
So final question, do you feel this time next year, if I was sitting here talking to you and you whip out your phone, you're looking at the 10-year treasury, where do you think we'd be in a range? Lower?
Lower. Unless the labor market, if the labor market broke, I actually think the 10-year yield could get below 3.21%. But if the economy is still firm, the 10-year yield should be in a range between 3.21 and 4.25. And if the spreads get better, you're looking at 5.75 to 7.25 rates. That at least is somewhat functional. When you start to get above 8%, it becomes problematic. So hopefully, in this case, next year, the growth rate of inflation falls more, Fed cuts rates, all positive for the housing market right now.
Logan, it's been a pleasure. It was live in person. I'm excited. So we'll check back in with Logan soon. But guys, that's it for now. Thanks for watching.
If you're already a real estate investor, you know that aside from cash flow, you also get huge tax benefits by investing in real estate. But are you taking full advantage of all the potential tax benefits? We've been working with Tim Looney at CSSI for a few years now, and he's saved us and our clients hundreds of thousands, if not millions of dollars in taxes doing cost segregation studies on their properties. Let me give you a few examples. We bought a property in 2019. If we had just used straight line depreciation, we would have saved about $18,750 in taxes. But because we did a cost seg, we saved $258,000. That's $239,350 more than standard straight line depreciation in the first year. The other great thing is, if you're classified as a real estate professional, you can apply this to other sources of income like W-2 or 1099 income, and you can also roll over any unused depreciation to future years. If you've owned your properties for a few years already, don't worry, you can still do a cost seg and save big on your taxes. This is not tax advice, so consult your CPA to see if you qualify to take advantage of these benefits. Call or text Tim at 318-469-9861 to get your complimentary property analysis. Once again, that's 318-469-9861. And I'll also include his information in the show notes. You guys don't want to miss out on these tax savings.